Hello, I'm Richard Hunter, Head of Markets at Interactive Investor. Despite various concerns, even the embattled FTSE100 posted a 12% gain in 2019, with the Boris Bounce providing a late turbocharge. Meanwhile, the US economy was on a tear and the main indices responded accordingly. Over 2019, the Dow Jones rose 22%, the S&P 500 29%, and the technology-laden Nasdaq index 35%. Despite the escalating tensions between the US and Iran, there are reasons to believe that 2020 could get off to a strong start. There was market relief after the UK election result, continued loose monetary policy by the major central banks, and with the US economy showing few signs of fatigue. Thus, the central question is whether attitude to risk will be reducing or whether the risks themselves will be reducing. Re-election looks a distinct possibility for President Trump in November in what could be a defining moment for markets. Nearer the time, investors can expect a barrage of tweets from the present incumbent, trumpeting the economic achievements of the country since he took office in late 2016. It is hoped that loose monetary conditions and a robust consumer will continue, thus avoiding a recession in the world's largest economy. Economic growth in the US is expected to slow in 2020 with muted inflation, although wage inflation needs to be monitored, and the movement of the Federal Reserve to rate-cutting mode in 2019 was designed to head off the potential of recession for the time being. The canary in the coal mine will continue to be earnings, particularly in the US, and the acid test will come if the consumer showed any signs of retrenchment. The US economy is highly geared towards consumer spending, so one area which is currently under scrutiny is the discretionary spend sector. At the moment, the signs remain relatively healthy, but if consumer confidence indicators started to dip, or if companies themselves start providing forward guidance which is less than positive, there would inevitably be talk of recession in the world's largest economy, which itself would ignite concerns elsewhere. The UK has been uninvestable according to a number of international institutional investors and has largely missed out on recent global rallies. In 2017, the FTSE100 added 7.6%, but in 2018 the decline was 12.5%. Some of this underperformance has been mitigated following the election result. But with the UK having long been regarded as undervalued, could 2020 be the year when the UK has its moment in the sun? The China-US talks will continue to dominate investment headlines until such time an ultimate resolution of some kind is found. The US president's relatively recent volleys against the likes of Argentina, Brazil and France have added to concerns that the brakes could inadvertently be put on global economic growth. And this is quite apart from the delicate Iranian situation. It's difficult to say how far afield international investors may go in their hunt for income, but UK investors need look little further than the FTSE 100, which on average is currently yielding 4.5%. With no obvious catalyst for large-scale interest rate rises on the horizon, this is likely to add to the attractiveness of what has been a market under pressure. January will herald the onset of the full-year reporting season, with corporate earnings hopefully continuing the positive momentum of the previous quarters. Of equal interest will be any outlook comments or guidance, which could well set the scene for what could be a challenging year. Of particular interest will be the index, which could be the one to watch, either stocks specifically or as a whole. For 2020, the FTSE 100 could well see an overdue return to form.